consistent growth again, and margin momentum for both auto and farm. Auto volumes up 16%. Market share has increased to 23%, which is 200 basis points higher than the same quarter last year. Farm volume is up 20%. Also a significant market share gain of 240 basis points, this time to 44.2%. Margins have a great story as well. I know there were a number of questions in the past on auto margins. We are at 9.7% now, up 120 basis points. And farm PBIT margin is 18.1%, also up significantly. So very, very strong story on both auto and farm. But beyond that, our turnaround businesses are on track, and we're not going to call them turnaround businesses from next quarter onwards. We're going to talk about them achieving full potential, because TechM's on a good track. EBIT has improved significantly. There's a continued focus on margin expansion to the plan of 15% that has been laid out by the CEO. Mahindra Finance, profit after tax is up 47%, assets under management up 19%, and GS3 continues to stay below 4%, despite some of the challenges that we've seen in the economy. So overall, all our businesses are operating on a very strong path, resulting in a consolidated profit after tax up 20% over the previous year. A quick snapshot here. Revenue up 17% year over year. On a year-to-date basis, it's up 13%. And profit after tax has achieved the 2020, up 20% for the quarter, and up 20% year-to-date as well. As you look at the key drivers, auto and farm have increased 16% year over year. TechM and Mahindra Finance are up 1.9 times and 47% respectively. And our growth gems are up 33%. Well, Rajesh will cover auto and farm in more detail. The key messages here are not just the SUV revenue market share, but also the LCV, less than 3.5 ton market share, which is now 51.9%. We've crossed the 50% threshold on this, so up to 30 basis points. And for farm, while market share has increased, farm machinery revenue is up 12% as well. As I mentioned, we shall talk about achieving full potential now for Mahindra Finance and Tech Mahindra. You see the GS3 and asset under management numbers for Mahindra Finance, and for TechM, some green shoots in telecom, or green shoots in BFSI and healthcare, some new deal wins in telecom, and getting back to a margin recovery path. So overall, as we have promised in the past, a consistent delivery on commitments. ROE continues to stay around 18%, which we have promised. And EPS, we had promised a 15 to 20% growth from F21 onwards. At this point, it's significantly higher than that and continues on a good trajectory. With that, I'd like to invite Rajesh to talk about auto and farm.
Hi, good afternoon, everyone. I'll start with farm, and you can see here we've had a very healthy volume growth in Q3, 20%. Exports have been up 14. Anish just spoke about the market share, so 2.4 percentage points gain in the market share, which is our highest ever Q3 tractor market share. This gives you the trend line of where we are on the market share. You can see that we've gained through the year 1.7 share points as well. Farm machinery, again, continues to grow at a reasonably healthy rate. On a YTD basis, that's at 20%. The revenue is up 11%, and the PBIT is up 29% for consolidated. So that includes our global subs. And the margins on the right, what you see is the core tractor margin, which is now at a very healthy level of 19.5%. Just to recap, core tractors is domestic tractor business, plus the exports that we do from India, plus farm machine. Sorry, it excludes power all and farm machines. We always show you this chart to show you the steady rate or the band in which we operate our margins, irrespective of what's happening to the industry. And the gray line shows you the volatility in the industry, but the ability to maintain margins. And of course, now you can see it going up to 19.5% as Q3 demand has got stronger. We expect the industry to grow at 15% plus in Q4, which will take us to a annual expected industry growth of around 7% plus. And there's several positive factors that we are seeing which are enabling that, one of which is the reservoir levels, which are at a very good level, 16% over the long period average. The Rabi sowing has been pretty smooth. It's at 103% of the Rabi area has been sown. So good progress on Rabi, and a strong Kharif production growth of about 5%. And we've also seen hikes in MSPs, which is overall raising the inflation price at an output level, and that's helping the terms of trade as well, which remain favorable, where output inflation is right now more than input inflation. So that was on the tractor side. On the auto side, again, it's been a very strong growth period. Anish has covered some of these numbers, so I'm not going to dwell too much on that. Both the growth in the LCV and the SUV market share. This gives you a trend line of how our volumes have grown. In spite of having a very significantly higher per unit average realization compared to anyone else, we continue to be number 2 on volume market share as well, apart from being number 1 on the revenue market share in SUVs. We got several Car of the Year awards. The Autocar Car of the Year, the ICOTY, which is called the Indian Car of the Year, and some others as well for the launch of the Thar Rocks. We've grown our LCV, this is the LCV less than 3.5 tons. While the industry growth has been very muted, there was small single-digit growth in Q3. The overall growth has come out of market share increase, which continues to be strong. Last mile mobility, we maintain our leadership. The important thing I want to flag off on this slide is the pace at which electric three-wheelers is penetrating. A couple of quarters back, we spoke about getting close to 20% penetration. Right now in Q3, it's close to 25% penetration. So this is probably one category in the country which is penetrating at a very rapid rate, and we see that trend continue through Q3 as well. The auto revenue grew 21% consolidated. The PBIT grew 31%. And that's reflected, as you see, in the standalone margins, which are now up to 9.7%. I'm going to take a couple of minutes to explain this, and Amar will reinforce this again, because this is important to understand this slide and the next in the way we will bring out our results. These are more dummy numbers right now because we haven't really sold any electric vehicles in Q3. But what you see on the left will be the auto standalone as reported. That has 2 subcomponents. The auto standalone will have a contract manufacturing arrangement. So the arrangement is M&M Limited, which is part of auto standalone, makes the electric SUVs for Mahindra Electric and sells them to Mahindra Electric, which sells them to dealers. The only margin that sits in auto standalone is the conversion cost, margin on the conversion cost, not margin on the product. What that means is the percentage margin in auto standalone has a component of conversion cost. So that sits in there. And we will also show you auto standalone without the manufacturing of electric vehicles in M&M. So you can see both these numbers separately, so that the effect of conversion cost sitting in M&M auto standalone is isolated from the rest of the business. So we'll show you these 2 numbers separately as we go forward. We'll also show you the end-to-end margins on electric vehicles. which is going to be a sum total of two things. The margin on conversion cost, will sit in auto standalone. That's what you see on your left. That also has a small margin that we make on the product development expenses that we incur in M&M. So that's the box on the left. On the right, you will see MEAL, which is Mahindra Electric, as a standalone company. And we'll show you the total of that. That will show you what is the end-to-end margin that we make in our electric business, sitting between M&M and between Mahindra Electric. So as we move into Q4, this is more to kind of prepare you all for how the numbers will be shown starting Q4. Of course, since there has been no revenue in Q3 of electric vehicles, that's billing started in the Q4. These are just indicative formats at the moment. You will see these populated for Q4. A couple of quick slides on where we are on our electric SUVs. You've been talking about this over the previous few quarters to say that what we are here to do is create a lifestyle opportunity, a lifestyle set of products, and make our electric SUVs objects of desire. We've revealed them, as all of you are familiar, in November. We've then done a walk around of our facilities through what we call the Technology Day in early January, and we're going to be starting booking soon. The three principles on which we differentiated ourselves have been the design, the human-machine interface, and all the software capability, and the high-tech features. And we had said these are the points on which we're going to differentiate ourselves. As we've been with customers and done several test drives over the last few weeks, we are seeing these play out as very, very strong strengths of our proposition. So what we've seen is game-changing features. A very strong part of the proposition has been a real-world city range of 500 plus kilometers, and creating a charge.in, which is a team of people to enable customers or prospects to set up charging either at their home or their office. Of course, there's a separate set of work we're doing with the government on creating more public charging, especially on intercity drives. We've also said that we expect the initial phase to have a total volume between the two products of about 5,000 a month. We will open bookings on the 14th of Feb, and we are right now into a build-up into that, so more on that after 14th Feb. Let me close with the TV commercial, which we are running now, just started a couple of days back, which is a continuation of the TV commercial you all saw in November. So I'll end with that and click here.
In US and Europe. 17% up for Mahindra Finance and double-digit growth in our growth gems. So pretty amazing growth that you see across the board. That has translated to similar kind of results on the profit after tax line, 20% in auto, 11% in farm, all of the others contributing significantly. What we don't call out, because it is not material at a total M&M level, but did impact our financials, was a significant mark-to-market in one of our investments. This is the KG Mobility investment that we have in Korea that was impacted by what is happening in Korea and had a significant year-over-year decline of almost 170 crores. That is in the profit estimate. So without that, the profits would have been up even further. So it's not a cash loss, it's an accounting loss that we do have to take. And as I mentioned, at a total M&M level, it is not material enough for us to call out, but I did want you to have that color. When you think about this translated into how everything's come together, I've been emphasizing this and I want you to take note of this again. You can see that the services part of our group continues to deliver a significant year-over-year increase in profitability. And that is important for us because then you have a very well-balanced portfolio. While the auto and farm businesses are doing extremely well, without a doubt, it is important to call out that our services franchise is delivering a lot as well. And you can see some of that impact that I talked about of the mark-to-market in the growth gems and investment lines, which has actually gone from a 94 CR positive last year to a negative 3 this year. On a standalone basis, again, we've talked about some of the growth, so I'm not going to emphasize on this too much. I would just like to round up this entire section by saying 3 things that are important for you to take away. Our domestic operations are doing incredibly well, and we expect that the businesses have the momentum to continue. International is weak, driven by macro headwinds in those international markets. So it's not our business performance. Our businesses have actually held up quite well, but there are macro headwinds in those markets which have been challenging. And as you look at international operations, it's important for us to look at where is there a structural change in the market versus where it's a temporary headwind. And that's an evaluation, especially in our farm businesses, that we'll continue to do in the 4th quarter. And we expect to reach some decisions regarding our international operations in the 4th quarter. Okay? And then the third message, which is not here in the pages, but I do want you to know, we continue to do extremely well on cash generation. From the beginning of the year, the businesses have generated over 4,000 crores of cash, and this is despite spending significant amount of increased capex in our electric vehicle portfolio that you are all aware of. Rajesh did emphasize the reporting change that will come. I just want to again reiterate what we are going to be doing. We are going to carve out the contract manufacturing part of the e-SUVs from the auto financials so that you can see wing-to-wing margins on the e-SUVs, and you don't have 2 places where you have to look for the margins. This is just the way this is set up for optimizing our synergies, but in the end, from a financial standpoint, you'd want to see how that 9.7% PBIT that you saw on the auto side continues over the years on the ICE side, and we want to be fully transparent on how we are doing on the EVs as well. Okay? So I'll wrap up here, and we will open it up for questions.
Thank you. Thanks, Amar. So may I request those present here to please first introduce yourself. It'll help us with our, backup when we come back again, and the media house that you represent, please, followed by a question. Thank you. Yeah, Tushar from NDTV. Yeah.
Tushar from NTV Profit. My first question is to Mr. Anish Shah. Your first thoughts on the RBI rate cut and the income tax relief that has come for the middle class, and how it will affect the economy and affect demand for you going ahead. To Mr. Jejurikar, since the income tax relief plays into the hands of the middle class more, would you divert production towards models that fit their spending potential, like the 3XO? Is a second subcompact SUV will be of consideration, given your competition already has that? Most of them have at least 2 products in that space. Mr. Barua, I think most of it was you answered in the how the EV margins will be calculated here on. But just wanted to ask, how's the cost picture evolving for you now that the EVs are going into production, and the production of the 3XO and the ROX have now matured. So in terms of bill of materials, how is they evolving? Thank you so much.
So Tushar, I'll start with your question on the budget as well as the rate cuts. We have said earlier that we believe the fundamentals for the Indian economy are very strong, and we've seen some blips in the short run. The relief in terms of taxation for middle class puts more money in their hands, and that will create a demand stimulus, which is going to help and in turn translate to greater capex from a private sector as well, which has also been an area that has been lacking in some way. Though at Mahindra, you've seen we've grown with a fair amount of capex investments over the last few years as well. And similarly, the rate cut also will help in terms of creating a little bit more of a demand stimulus. So both are positive moves from an economic standpoint. Rajesh?
Yeah, Tushar, hi. On the question of will we focus more on 3XO, we've in the past spoken about what our capacity on 3XO is, which is about 9,000. If you remember, that's the number we had put out. The demand for 3XO has been strong, skewing more towards gasoline than we were ready for. So, which is good news because we've always been known to be a diesel-oriented brand, and we're seeing almost right now 70% of our sales are gasoline, and the demand for gasoline is even higher than that as a percentage of the total production. So that's one of the things that we're doing to step up the 3XO production, which is unlock the diesel gasoline mix. We will try to take production up somewhat more. We actually launched the 3XO in South Africa recently, just as an example, and it's doing extremely well in South Africa. And incidentally or coincidentally, as we're talking today, we just got news a couple of days back that we are now in the top 9 brands across all OEMs in South Africa. So that's a very positive trend. We're seeing very good momentum there. So we are having to balance some of our 3XO capacity between what we sell in India and what's going for exports as well. But more specifically to your point on the effect of income tax relief, products like 3XO will see better traction because 3XO does go a lot into the salaried segment, and especially those will get income tax relief. So that will be an upside opportunity for demand on an ongoing basis. We may not be able to fully capitalize that in the short run for the reasons that I told you. And while we won't comment specifically on product strategy for the future, we do think that demand is going to be very robust for products 10 to 25 lakhs in the country, and our strategy is to play in the 7 to 25. Of course, now with the electric SUVs, we're going up to 30. But really, we are playing that band, and I can't comment specifically on whether we'll do a second compact SUV or not. But we see an overall, as Anish said, a very strong growth story in the Indian economy.
And just to add, it's very heartening to see the demand for gasoline more because auto experts have been saying for a while that have the best gasoline engines, and now we are seeing that translate to consumer demand as well.
And Tushar, if you had asked me the same question 3 months back, it would have been a straightforward answer. It's getting a bit complicated, and let me explain. There are 3 dynamics at play right now. First is, of course, what you can see in the margin of the auto division is a lot of great effort on cost out and optimizing all of the inputs that go into our vehicles, right? And that's what has translated into improved margins over there, in addition to mix and other factors. 2 new things are emerging right now. One, the overall commodity market was very benign for the longest time. While it appears benign on the surface, when you start going deeper, you see that steel is the only reason it's overall benign. Others have started creeping up. So there is a raw material inflation. that many of our competition have also called out. So far, it has remained benign for us, but that's a challenge. On the farm side as well, we are seeing some of the pressure of rubber costs, etc. And then there is a third dynamic which has become quite pronounced right now, which is the exchange rate. In our electric vehicles in particular, there is an import content that you're well familiar with, and that will become dearer as the exchange rates go against the Indian rupee right now. So that's something that we have to work through. So we'll have to work harder to do some of the magic that the team delivers on a consistent basis, which is the product cost out that they've been driving. Especially, we have a strategic sourcing unit which focuses on this all the time. So those are the, it's a little bit of a longish answer, but I think it was important to give you that there are two new dynamics that have emerged in the last 3 months that we have to watch.
Yes.
Good afternoon, gentlemen. This is Aman Ahmed from Car and Bike. Congratulations on a strong quarter. I want to start with the 3XO since we were just talking about it. If you could just share the figures that you're doing on a monthly basis for the 3XO right now. Also, what is the split between manual and automatic transmissions on the 3XO? Secondly, I wanted to ask about the Thar ROXX and the Thar 3-door. What is the sort of volume that you're seeing there on a monthly basis? What's the split between the two? Are you seeing any cross-shopping happening over there?
Yeah. So on 3XO, like I just shared, we have a manufacturing capability of about 9,000 a month. We're close to that. Last month or two, December, we had some plant shutdown, which we do typically at a year-end time. So some of it was affected by that. Some of the domestic volume is affected by the exports that we had to prioritize for South Africa, given that it's a new market with a new product. But we are in the region of 9,000 as the total number. The domestic number varies a bit depending on what's happening on export. So that's about the number that we have for 3XO. Vijay can correct me if I'm wrong on the auto transmission. It's about 25%, I think, or about 25%. So it's about 25% is the auto transmission there. On ROXX, we have actually seen very strong demand even for the 3-door. When we launched ROXX in August, we had said the total capacity there was about 9,000 plus, and with a certain amount of fungibility between the 3-door and the 5-door ROXX. So we've worked over the last 4 months to remove or make the fungibility complete. So now as we are into February, we have complete fungibility on what we can do between 3-door and 5-door. Which will allow us to improve ROXX production more than what it was. While we are doing that, we still see a very strong demand for 3-door. So, but at this point of time, our capacity, total capacity is 9,000. As you know, the ROXX demand is stronger than that, and we do have a long waiting period for ROXX. But because the 3-door demand is strong, and we do think that's a very different segment, and we do want to continue making sure that product is available for that segment, we'll have to do some kind of a ratio, which we now have manufacturing fungibility to do. So demand is good for both.
Right, but could you share some numbers just so we have...
So right now we're doing about 30% of the volume on 3-door and the balance on ROXX because of the long waiting period on ROXX. But 3-door potentially can be even higher, and the 5-door, of course, the demand is very strong.
And in the presentation, you mentioned that right now you're expecting about 5,000 units a month for the B6 and the XEV9e combined. So I want to understand what is the split that you foresee over there? Which model do you see having higher demand, at least at the outset?
Let's wait for 14th Feb. That's when we'll get a better feel. Right now, it's all conversations.
Right. Okay. Thank you.
I think I'll take one online, which has come online. Alisha Sachdev from Bloomberg. Do you have any ICE engine launches planned for this year? Do you see EV sales revving up this year? What will it further your sales growth trajectory overall?
I'm guessing, Alisha, the question is new products with ICE engine and not the launch of a new engine. So No, we don't have a new launch for ICE in the current calendar year. There will be launches following next year. We've just launched 2 new products which are less than 12 months in calendar in a total period. So
you might want to clarify, we'll have some refreshes.
yeah.
She mentions launches, but yeah, we
sorry.
can add during any refreshes.
So mainly we will see a lot of activity with the newer products in 2026 calendar. On the build-up of the electric portfolio, we said we'll start with 5,000 a month, and we have said that by 2027 we will get to 20 to 30% of our volumes will come out of electrics, and that is in a range of 120,000 to 200,000 per annum volume. That's what we're working towards for 2027.
Okay, Sohini Das from Business Standard would like to know, the rural growth in Jan has been very good for the industry. What has been your Jan rural growth rate and YTD's rural urban growth rate ratio? Also, what is the current inventory days with the dealers? This is auto specifically.
Yeah, so we actually we've seen a strong rural revival, but also urban demand has been very strong. So for us, the urban and rural growth rates have been very similar. We do know that some of the other OEMs have seen a faster growth rate in rural than urban, but for us, when we've kind of re-looked at the numbers or analyzed the numbers, it seems to indicate that the growth rate is equally split between urban and rural. So when we say the SUV demand has grown 20%, plus minus 2% difference between urban and rural, but they're by and large the same rate of growth in urban and rural for us. It's of course a function of the portfolio that we have and the kind of customers that we are getting, and a good dispersion that we have between urban and rural right now. Inventory, as we said last time, we are within our norms and roughly at about 30 days.
Yeah, Shelly.
If you can just touch upon your go-to-market strategy for the BEVs, how many dealerships will be selling the BEVs, and how they are sort of prepping up for the new models in terms of the infrastructure, charging, etc.
Yeah, so it's 250 plus, right? Yeah, about 250 plus dealer outlets will be opening up for bookings on 14th Feb, which is a very large chunk of our SUV selling universe. So almost everybody is on board. We are in a phased manner upping the experience through multiple sets of actions, one of which you spoke about, which is the infrastructure. So we have upgraded the look of our showrooms, both for EV and ICE. So it's not like we've created a separate EV corner, and we'll share more about that over the next few days. And for any of you who want to visit any of our dealerships on the weekend, you will get to see that in our dealerships, as a lot of our dealers will get into their launch events in their outlets. So that is one of the things we're doing. We've also strengthened the quality of the manpower, because these are very high-tech products. So we have hired almost 500 people with experience in selling tech, luxury, premium brands across the country, supported by a Mahindra hiring process. Over and about that, the dealers have added themselves about 700-800 people plus. So it's a large set of new people being brought in to bring out all the tech through the test drives and the sales story. Similar kind of upgradation has been done on the service side. Of course, these are connected vehicles, and a lot of the updates will happen over the air as we go along, and there's onboard diagnostics and all of that. So it's but we needed to strengthen the service team to enable that as well. Is that what you had in mind, Shelly?
Yeah, Darshan.
Hi, good afternoon, gentlemen. This is Darshan from Autocar Professional. My question is to Mr. Barua. You mentioned that you will take a call on farm subsidiaries in Q4. What is the call you are referring to?
So as I mentioned to you, there are two types of markets that we are experiencing right now. There are markets which are just experiencing temporary disruptions, either because high interest rate environment or there are other factors, macro factors, which are just creating a blip. And then there are markets which have structural decline in them. You know, some of the European markets would come in that. So one of the things we are doing as we are looking at the overall Farm International strategy is, where is it that we see a structural decline in the market? And do we have a clear organic play there? And if not, then what do we need to do to pivot our business to be different with a structurally mature and declining market effectively, right? So those are some of the evaluations that the team is running, and we should have a clear view of that in the fourth quarter.
My second question is, could you share your guidance on the PV or CV segment for the rest of FY25, Q4?
What are the first thing you said? Second you said CV. What are the first?
PV, passenger vehicles.
PV.
Yeah.
Okay. First, let me try and take the CV question, which is the one we are struggling with. We were hoping that we have started to see a revival in Q3. It's too early to say whether that's playing out in Q4. I mean, at this point of time, we think there'll be a growth in CV. When I'm saying CV, I'm saying less than 3.5 ton. We think it'll maybe small single digit in LCV 3.5 ton in Q4. It's right now not showing sign of a very big revival yet. Hopefully we will start seeing better of that next year. On the PV side, I would think for the industry, it will be in single digits.
Thank you.
Yeah, Nehal.
Good afternoon. I'm Nehal from Mint. Sir, I just wanted to understand, by my calculation, your standalone EBITDA margins are 15.4% this quarter compared to 14.2% last year. So just wanted to understand, when the entire industry has seen EBITDA margin reduction this quarter, what has helped you improve margins? You have briefly touched upon it in terms of better product mix, but can we get some more granular details on it? When you say better product mix, do you mean high margin models, or within your models higher margin variants that you've been able to sell, which is helping you?
I would think 2-3 things. One is we've not had to discount too much through the festival season and even post that as well. That's also because a large part of our portfolio is on a very strong demand pipeline, so we've not really had to either do festival discounts or post-festival discounts in Q3. So that, I think, has been one of the key enablers. The second one has been that we did take some price increase in the beginning of the quarter on some of our models, which needed price correction. We took something on 3XO, which was the first increase we took after launch. We also took something on XUV 700. So, we had a couple of price increases and we didn't really discount. Apart from that, as Amar said, there are multiple initiatives that we always do to get cost out, including material cost, and then that starts playing out. So it's a combination of all of these. Plus, of course, operating leverage, because it's a strong volume growth.
How's the discounting scenario now in Q4, the first months?
But there's no difference in the discounting, except that we always have to run something on a 2024 win, which is a standard thing anytime as you get into January. So if dealers are carrying some inventory of 2024, which is bound to be some inventory, so obviously there will be discounts running on that, but there's no other material change in discounting.
Understood. If I can squeeze in one more question.
Yes, please.
Mr. Barua, you mentioned that commodities have been benign, but steel, especially steel. Now the government of India is looking for some kind of protective measures for the Indian industry. At least a study is going on. If that happens, just trying to understand steel as a cost of your overall expenses, what would your exposure be?
So I don't have an exact percentage, but what I can tell you is within steel also there are multiple grades, right? And the measures that might come into might not be as relevant from an overall, because there's a overall steel oversupply situation right now. So what is meant for more construction activity might not necessarily be the impact that we'll see in the automobiles. But I don't know, Rajesh, if you have a different...
I'll add something to that. 93% of our steel is procured from within the country. And
right, sir. I think I should clarify what I meant by the question is if some duty measures come in and steel prices in the Indian markets also correct on the upwards trajectory. Just trying to understand to that scenario, what kind of exposure would you have?
Yes, and I was getting to that second part later, which is our sense is the government will look at the impact on all user industries of steel, which will be across the board, and ensure that the specific problem which is around dumping, which is being looked at, is addressed, but the dumping problem shouldn't really translate into higher prices that impact all industries, because that will essentially take inflation up and take away some of the good work that's been done right now to provide a demand stimulus for the industry, for the economy overall. So that's the expectation that we have in terms of that balance, and we shall see how that plays out.
Thank you, sir. Mr. Jejurikar, if you can just help me with a number in terms of steel as a constituent of your bill of materials.
I think it'll firstly be very different for auto and tractors. Yeah. On the auto side.
Thank you.
Swaraj, you had a question, and Hormaz also you have a question.
Thanks. The rate at which M&M is growing in the PV segment, it looks like you'll be fast running out of capacity.
That's a good problem to have.
Any plans of hiking it further from here on?
Yeah, so just to Swaraj recap what we've said so far. We were at 49, we said end of last quarter, then we said we're increasing it by 5 for rocks. So that took us to about 54. Then we've added the capacity for electric SUVs, which takes us to whatever, let's say another 8-10,000, so mid 60s. And I think that now that is a good number as an overall SUV capacity. Now, like I said earlier, we have some specific product / aggregate capacities to debottleneck. So we definitely need more gasoline capacity on 3XO than what we have. We do need to increase some capacities on Thar and the 3XO portfolio. And these are small incremental capacity enhancements we'll do over the next 3 to 6 months. But right now we're not looking at any significant expansion capacity till we really see what is the balancing that will happen between ICE and EV volumes. We'll get a feel of that over the next 3 to 6 months.
And the arrangement, the contract manufacturing arrangement between NEIL and M&M, does this mean that M&M standalone will not make or sell electric passenger vehicles, and that will be, all such products will be the exclusive business of NEIL from here on? No electric PVs will be made within M&M.
No, the electric EVs will be manufactured within M&M and sold to Mahindra Electric. That's the contract manufacturing. So Mahindra Electric is outsourcing manufacturing to M&M on a contract manufacturing basis. They will be sold exclusively through NEIL, through the dealer network. Does that clarify?
Yes, okay. And just last question on the long stance that M&M has held on hybrids. Are we still sticking on to it, and that as and when the opportunity, if there is there, we can look at it, or has there been a change of stance on that?
We are still sticking to it.
Thank you.
Hormaz, Nihal will come back to you. There are quite a few. Yeah.
No, XUV affordable right now is still in M&M AD. Is not being sold through NEIL at this point of time. In Q4 as well. It's in M&M, not in NEIL. Hormaz?
Hormaz, do you have a mic? We'll come back to you after that. Yeah, thanks.
Hi. Rajesh, you had mentioned that on 3XO, some of the capacity is going to towards South Africa, where it's doing quite well. And Mahindra as a brand is also in the top 10. Could you just share some numbers, like 3XO sales on a monthly basis in South Africa and overall Mahindra brand as well?
The 3XO is in the region of 700 odd a month right now in South Africa alone. And overall, I think we are at close to 1200 or 1300.
Thanks.
Amay? Yeah.
I'm sorry, almost we are going in a market which is being flat. South Africa is being flat, another decline. So we've been growing in a market that's been flat. Rates are now 50% of. So you've got our volume.
Hi, Amir Naik from Acco Drive. I just had two questions. One, the kind of demand for gasoline engines that you're seeing in the 3XO, is that also seen in segments above as well? I'm referring to the XUV 700 because it's a powerful engine. And the second one is I wanted to ask you about what are the expansion plans for Crore recycling, if you can put some light on that. Thank you.
Yes, on the first question, the 3XO, the category in which 3XO plays is a very gasoline driven category. So the category itself is 75-80% gasoline, and demand for us is in line with the category. It's just that since we've traditionally had a strong diesel presence, we were expecting that there will be a continuation of that ratio, but the gasoline demand is very strong. In other products like XUV 700, it's in the region of 25-30%. Except the Crore question you want to take, Ramar?
So on Crore, we have, as you know, we have a very strong franchise on auto recycling. It's actually the largest in the organized sector. And so we are looking forward to a more regulated environment that should give that business significant fillip. It has capacity right now, and it has expansion plans which can be put into motion in 3 to 6 months if the regulations change and demand goes up significantly.
Yeah. Ketan, and then we'll come back to some online questions.
Sir, yeah. If you could just reflect a little bit on the international subsidiaries of farm equipment business. One on the US subsidiary, how is it going? On MAM, Mitsubishi Agricultural Machinery, what is the plan? You had launched OJA as well, so how is the global expansion going? And somehow, in a way, it also kind of ties into what Mr. Barua mentioned and Rajesh also mentioned about how in the Q4 we'll have visibility on the farm subsidiary. So just a broad overview on how some of these subsidiaries doing and what's the globalization trajectory looking like?
Yeah, hi Ketan. So first let's take US. Our market share has been stable in US, and I think Amar played that out earlier as well. The category over the last 2.5 years, I think we've seen almost 13, 14 quarters, 12 quarters of category degrowth in US continuously. So the market size is literally in the last 2.5, 3 years become like 50-60% of what it was 2 years back. So there's been a significant decline in the category. We are beginning to see some uptick that's happening from January in the category for as the political environment or situation there has become more now known or whatever. So I think that is one factor. The second thing is there has been a wait and watch on what happens on the Fed interest rates, and that still has to play out. So I think all through last year there was uncertainty on what will happen to interest rate. The category is fairly sensitive to interest rates there, and because interest rates had moved up over the last couple of years in US and there was an anticipation that they will start coming down. What we need to see is the pace at which it comes down. It will definitely come down. We've got to see the pace at which it will come down. So right now the category has been under pressure in US, and that's what Amar was alluding to. We have a strong presence there. OJA has got a good response. We're in the process of rolling out OJA. We're just breaking our marketing campaign there. Of course, Jan, Feb, March is not a big season there because it's winter, as you can imagine. That's not really a time for selling large number of tractors in many parts of the country. So the season there will pick up post-March, which is the April, May, June quarter. But we're building up and preparing towards that. So that's on the US piece. In Japan, the category has been in a decline for a very long period of time. The average age of the farmer in Japan is more than 65. So Japan is facing a problem of labor on farm kind of situation, and we need to reckon that in, because that's affecting all the categories. So we are in tractors, we are in rice transplanters, we are in harvesters. So we're in the 3 core categories there. We're the number 4 player in Japan by way of market share. Market share has remained stable, but again we have a challenge of a declining industry. So I think these are a couple of things, some of which we will have to think of what we need to do on cost, more like what in Japan. But in the US, we are reasonably confident that the market will bounce back soon, and we'll get back to a growth path.
So any corrective measures both in US and in Japan, probably a diversification of portfolio in US, looking at higher horsepower tractors. In Japan, probably look at more global in nature, given the fact that the home market is weak. Look at Southeast Asia, where Mitsubishi as a brand probably has a better equity. Any measures to overcome these challenges?
In US, it will be focused around the launch of OJA, and we don't call it OJA there. It's because there we follow the Mahindra's numeric series approach, and that's what we've done right now. So we don't use the brand name OJA. It's the OJA platform and the OJA tractor that goes there with numeric seriesing to the brand Mahindra. So that will be the focus. We're not going into high horsepower because that's not a segment in which we play. When I'm saying not high, it's not more than 100 horsepower. So we play in the less than 100 horsepower segment. In Japan, I think we're just going to look more around managing of costs.
Okay, thank you.
Yeah. Shaili, you have a question, and then we'll go online.
Rajesh, you can give us some color on the M&HCV business. What kind of volumes are you doing? The segment has seen a bit of a muted demand because the infrastructure growth and other things, the way people had anticipated after elections, it did not pick up. So an outlook on the segment, and what are your plans? What are you?
Yeah, you're right. The segment has been very muted, the MHCV segment, and it's surprising now because it's been muted for a while. So, we do hope that the category will start picking up. We are doing roughly about 1,000 a month kind of numbers, about let's say 12,000 per annum kind of volumes. But like you said, that with all the investments that are coming into infrastructure development, we should start seeing a segment pick up in MHCV especially.
Nandini Sengupta from Times of India would like to know if the group is looking at investing in new businesses segments like health insurance.
So no change from what we said earlier. We've outlined the policies, the approach that we will take, and we continue to look at one potential new sector with a clear view that it would be where we have strengths, where we can generate returns higher than the rest of the industry, and where we can build skill.
T. Murali from Mobility Outlook would like to know our insights on preparations being made at service centers for the BE6 and XEV9E, particularly in terms of infrastructure development, technician training, and overall readiness to support these new models.
Yeah, hi Murali. I did answer that question for Shaili earlier, but I'll just give you a quick recap. We are revamping our dealership look at the showroom end as well as at our workshops by way of quality of manpower, the use of advanced analytical diagnostic tools to be able to handle any service issues or service quality that would come out of the new products or that new products would need. We are deploying a fair amount of resources at the dealerships and internally to provide for that.
Mugdha Mishra from NDTV would like to know what's the need of this contract manufacturing structure within M&M and MEAL, and she also would like to know what's the total contribution of exports currently, and what is your export strategy from here on?
I didn't understand the first question. What is the need?
Need of this contract manufacturing structure within M&M and
Okay, so Mugdha, basically we set up, we are leveraging our current Chakan facility, and I think you were there with us, if I remember correctly, in Chakan, or maybe you didn't come to Chakan, but it's so we've created separate body shop and assembly line for the electric vehicles, but we leverage all the utilities and the paint shop as common for the rest of the portfolio product. So basically keeping manufacturing of Born Electric vehicles within the Chakan plant allows us to leverage the synergy, manage fungibility of labor across shops, and hence get the benefit of the full value of synergy within the M&M of the M&M auto system. If we were to set up a separate greenfield project only for electric vehicle assembly, then we would lose the value of all the synergy that we can get and leveraging or full sweating of the assets. We do have a separate manufacturing facility just outside our Chakan plant for making of the battery pack, but that too is a part of M&M, and because that feeds into the product manufacturing process, and this contract manufacturing arrangement allows us to get the full value of synergy.
The export strategy?
Yeah, export, I think that it was what is our share of exports. So our share of exports right now is about 5% of on the auto side.
Yeah, Sohini has another question. Sohini from Business Standard. Kerala raises road tax on EVs. For vehicles above 20 lakh, it will be 10%, and above 15 lakh, 8%, from 5% now. How would you say this impacting demand in a state like Kerala, which has high penetration?
Yeah, Sohini, we too saw the WhatsApp a few minutes before we walked into this, so it's a little difficult to judge the impact of that on demand at this point of time. Yeah.
Anyone? Swaraj, yes. Online, we are done. Yeah. Yeah.
The board gave approval for setting up the Mahindra Advanced Technologies today for security solutions. In which area is this going to address? What's the idea behind setting up this company?
So we have been focused, it's a tiny business on security solutions today. So it's basically trying to streamline some of the businesses we have there into one company. That's about it.
Last question, Ketan.
Just a word on the electric three-wheeler business. How do you see Mahindra's position there? Recently, we saw Bajaj really making big inroads into the segment, and TVS and Hyundai have also got into partnership, and TVS also intends to get in there. So, what are some of the steps you are taking to protect your leadership at this point in time, and what's the growth potential do you see in the coming couple of years, given the fact that penetration has now reached 25%, as you said?
Yeah, so Ketan, actually these two go together. As we've always said, more competition in an evolving category is good for the category, and we're seeing that. Competition has led to the kind of growth rates that we're seeing, has led to a very rapid increase in penetration. Not very long back, just a few quarters back, I remember talking about, we're feeling very good that three-wheeler electric penetration is 9%. And then, before we realized it, we were at 20, and now we're at 25. Now that's happening because as more players come in, the ecosystem develops, there are more vehicles on road, there's a positive word of mouth around the cost of ownership. So competition actually helps grow a category of this kind. So we see this as a very positive move, and it's great that other players will come in which will enable that. The good news is that in spite of a very strong competitor coming in, we still remain number one. That is because it's a very focused effort from our side. We have a very strong product, and we have a strong product pipeline as well.
Thank you.
All right. Thank you. Thanks, everybody, for joining. If there is anything that we left behind, please mail it to us. We'll get back as soon as we can. There's some refreshments as well. Please help yourself. Thank you. Thanks. Thanks, Rajesh. No. Holding it, please.
Prepared?